Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Ewan MacKinnon of Maven Capital Partners to talk about the Maven VCTs. Hello Ewan, welcome to the studio.
Hi Jonathan.
So we're here to talk about the Maven VCTs. Firstly, for those who aren't familiar, what are they?
So we have four VCTs which are coming out to raise money this year, four generalist VCTs which invest in scale-up private companies. We're big proponents of the regional investment model. We have 12 offices throughout the UK, and that allows us to access companies throughout the regions of the UK, not just in the South East and London.
And they're reasonably well diversified VCTs as a pack. I think that's the one thing that probably stands out. Maybe 100 or so.
Absolutely. And that's probably something that's different about the Maven VCTs. We are very much in favour of portfolio theory. And each of the four VCTs have between 80 and 120 companies that we've invested in. So we're very, very well diversified, both in terms of number of companies and the sectors that they invest into.
And so the VCTs managed by Maven Capital Partners, who are Maven and what's your role there?
Sure. So Maven is a fund manager. We were established back in 2009. We used to be part of a listed fund manager, and we undertook our own buyout back in 2009. And that's when I joined. So I'm actually, or I was, new employee number one into the Maven group. So I've been with Maven for 16 years, and we're SME investors. We are specialists in investing in small and medium companies, and the VCTs are a big component part of what we do.
And so turning to where you invest, are there any particular sectors, any particular types of business models that you favour?
Sure. I mean, we are sector agnostic. It's probably easier to describe the sectors we don't invest in. So we don't favour hospitality, leisure and tourism, travel and tourism. We prefer B2B business models. So companies that have annual recurring revenue, sticky income streams are the types of companies that we prefer to invest in. And that can be across many different types of sectors. The three that we really favour are technology, and that can be across many subsectors, healthcare, and also advanced manufacturing.
And they tend to not be too cyclical as businesses. They tend to be fairly resistant to
Absolutely.
recession,
that's what we're looking for. And I think that's why we don't invest in some of the sectors I mentioned before. We're looking for companies that have consistent, steady growth that aren't cyclical by nature.
I guess we'll come on to examples in a second, but things like Crematoria, it's a classic non-cyclical business, I guess.
Absolutely. Absolutely. That's what we're looking for, are companies that will continue to grow, and we have really good visibility of the growth profile.
And the way you structure a deal, it might get a little bit complicated, but you tend to be fairly defensive in how you invest.
Yeah, pretty much every deal we invest in, we take a sales and liquidation preference. What that means is when the business does well, we will share in the equity proceeds by our percentage. And if the business doesn't go to plan, we are at the top of the capital stack, so we can get our money back if things don't go to plan. One of the issues, it's not an issue, but one of the risks of investing in early stage businesses is that they don't all go to plan. And therefore, by having those liquidation preferences at the top of the stack provides a downside protection.
And so turning to the investments, any recent examples that you've backed?
Yeah, sure. We've had a fairly busy year this year. Couple of examples come to mind. Blackdot is a company that our Bristol team invested in. Really interesting company that has a platform that takes data from multiple sources, so the web, the dark web, from social media, and allows companies and public sector organisations to look at financial crime potential, look at risk onboarding, and doing KYC checks. It's a company of scale. When we invested in it, it was doing over 4 million of revenue. In the short time we've been invested, it's now over 5 million of revenue and scaling very, very well. A totally different type of business is a company up in Scotland that our Edinburgh team invested in called PowerPhotonic. So it makes lenses that are used in lasers, which can be used in defence and also healthcare. A business that has scaled very well in the UK, and using our funding is going to open up an operation and scale in the US.
Interesting. And so turning to some of the more established holdings in the portfolio, perhaps some of those that sit in the top 10, how are they performing?
They're performing well. And actually I looked at stats in terms of how they're scaling and how many are now profitable. And what was quite surprising is even the post-2015 companies, those that were traditionally very early stage and often loss-making when we invested, out of our portfolio, now over 40% have now reached profitability. So not only are they scaling well, they're also scaling profitably as well. One of those that comes to mind is a business called Bud Systems. We invested in Bud about 4 years ago, and it was generating about 2 million of revenue. That is now over 6. And what it does is it provides a training platform for training providers, mainly for apprenticeships. It has over 600,000 users that have used the platform and over 100 customers as well. So a company that started as a very early stage business that has now reached size and scale and is generating over 6 million of revenue.
And I guess the ultimate goal with each of these businesses is to reach that exit. You've been fairly busy this year, I'd say, with exits.
Yeah.
Lots you can talk about.
Lots I can talk about. It's been a busy 2 years, actually. And we talked about that last year. Over the last 2 years, we've sold 8 companies, which has been very good. And I think that's one of the advantages of having such a big portfolio of companies. You know, as I said earlier, 80 to 100 companies, 120 companies. That means you'll inevitably, or you should inevitably, have an exit every year. And of late, you mentioned Horizon. Earlier, Horizon Crematoria was a company we invested in back in 2020, I think it was, might have been 2019. We fully exited that this year, made between 2 and 2.4 times return for our investors. And more recently, just last month, we exited a company called DPP, which was a maintenance provider for ventilation and HVAC units. One of our older companies, we invested in that pre-2015. I think we've been in that for about 11 or 12 years. And again, we made between 2 and 2.5 times return for our investors in that exit. So 2 really good exits. And on the back of that, we've had 2 interim dividends so far this year. And the first one on the back of Horizon was paid early because of that exit. So it has helped drive the dividends that we've delivered this year. And
I believe you may have changed your dividend target as a result.
Yeah, so last year actually we increased the dividend target from 5% to 6% of NAV, and I'm pleased to say we've been in excess of that. And those 2 exits that I've mentioned earlier will help us deliver that sort of level of dividend. So hopefully that will continue, and we can maybe exceed that as well if we get some good exits.
And we can't talk about all the good news without also talking about the risks. So for investors that are perhaps maybe new to the VCT, how would you describe the risks to them, and how might they be different to other VCTs?
Yeah, well, I mean, VCTs have to invest in early stage companies, and that means they are inherently risky types of businesses. So what we do to try and mitigate those risks are, well, there's probably 4 or 5 things we do. First of all, we do a lot of research up front. So when we look at a company, we will spend several months researching that business, doing internal diligence, but also external diligence. And we don't just look at the numbers. We'll look at the market, the competition, the IT, the tech, the insurance, and probably most importantly, the management. So we'll diligence management, reference them from named and unnamed referees. So we know the business that we're away to invest in. So that's the first thing we do. Once we're into a business, once we've invested, we do take quite a proactive approach. So we're quite hands-on. We'll always take a seat on the board. So we'll appoint one of my colleagues as a non-exec director. And we'll also appoint a non-exec chair to that board to provide help and guidance. Because although companies always have a business plan that goes like this, I don't think I've ever seen a business that actually achieves that business plan. There's going to be bumps along the way, and it's good to have somebody on your board that has experience of that. So that's the second thing that we do to help mitigate risk. Thirdly, and we discussed it earlier, is the portfolio theory. We make sure that we diversify. So we've got a very diversified portfolio. The top 10 account for no more than 25% of our NAV. So very, very diversified portfolio. And then finally, it's the structuring that we talked about earlier. We make sure that we have a downside liquidation preference on every transaction. So a few steps that we do to try and mitigate the risk of investing in early stage companies.
Would you say that's the defining feature of the Maven VCTs is the focus on risk management?
I mean, I think all VCT managers will focus on risk. I mean, it's part of what we all do, but I think that we are quite unique in having all the 5 steps, and in particular having such a diversified portfolio. I don't think there are others that have the number of companies that we have, and therefore a more diversified portfolio.
So taking everything we've just discussed, Ewan, for those who want to back a VCT this year, why should they be looking to back the Maven VCTs?
Sure. Well, we've been doing this for a long time. We're very experienced investors. As I say, 3 out of the 4 we've been managing since the early 2000s. Very diversified portfolio, both in terms of number of companies and also the sectors that they back. We've had a very good track record of exits. And on the back of that, we have got a 6% dividend target, which we have been managing to achieve, which provides good income for the investors who back the Maven VCTs.
Fantastic. Ewan MacKinnon of Maven Capital Partners, thank you very much.
Thank you.
If you're watching on YouTube, please press like and subscribe to the channel for more.